The markets, they never stop, but neither do we. You're listening to Fluid Finance. Welcome to the first episode of the Fluid Finance podcast. I'm Tejas, joined by my co-host Ariman. Let us present you with a scenario.
So consider this. You're a 21-year-old graduate who just passed out of college and landed their first job. Nice. It's even better when you get your first paycheck. The feeling is very nice. It's independent and all that. So what do you do when you get your first paycheck? Well, any logical, reasonable person would put all that money in their savings account because the savings account pays you 2.5-3% interest just for putting your money in there. Isn't that great? Not really, no. This is because of our friend inflation. Essentially, inflation is a general increase in prices of goods and services over a period of time, which is pretty much inevitable because you need inflation to grow as well. However, inflation devalues your money. So, for instance, let's say this person makes 10 lakhs a year. A year from now, that those 10 lakhs will not be worth 10 lakhs. They'll effectively be worth 9 lakh 30,000. This is because in India, the average inflation is about 7%. So your money is getting devalued by 7% year on year. If you put all your money in a savings account, let's say you're getting even 3%, you're you're losing the value of your money by 4% just straight up. That's obviously not a good thing because at the end of the day, you don't want to just you're working hard for that money. You don't want it to just get devalued.
I completely agree with you. I think inflation is one demon which no one can avoid, and an important one too, right? Because I understand that inflation is not all bad.
No, it's not because inflation is very important for countries that are developing, like India, whose economies are growing and at a good pace. You need inflation. However, our salaries don't really account for inflation. As a result, we have to accommodate, we have to adapt, and we have to, somehow overlap this inflation and grow our wealth.
How do you outpace this demon of inflation?
So there's a couple ways you can go about it. There's a few instruments that people invest in. There is the infamous fixed deposits, bank fixed deposits that our parents and grandparents have invested in for generations. They don't really do much for your money, really, because you're netting about 3.5 to 4% after taxes. If you're lucky, maybe even 4.5%, and inflation is 7%, so you're losing 3% of your money via an FD. Sure, it's very safe, but it's also just not doing much for your money. It's just making it worth less. It's just reducing your effective buying power. So instead, there's three main areas that where people invest and can invest, particularly if you're just an 18-year-old or if you're just out of college or whatever it is. You know, People invest in debt or bonds and the stock market or equity, and they also invest in real estate.
So you mentioned three instruments to invest in, but how do I know where to invest what? Say I have a lakh to start off with. How much do I invest in equity? How much do I invest in fixed income and real estate?
So the most important thing before you actually start off investing is to identify your risk appetite and to determine your risk appetite. What do I mean by that? The younger you are, the higher your appetite for risk should be. Doesn't mean it has to be, but it should be because let's say your portfolio is very high risk and you mess up and you lose a lot of money. Because you're young, because you started early, you have a lot of time to make that up. And as you grow older, you will obviously have more and more income. So you can account for the money that's lost, number one. And number two, you also don't have a lot of responsibilities as a 19-year-old, 21-year-old compared to when you're maybe 35, 36. Essentially, risk is very important. Risk is more important, I'd say, than return. You should always allocate a certain amount of money to a certain instrument. Essentially, what I'm saying is don't put all your eggs in one basket, but put most of them in one basket. So, for instance, when we talk about debt and bonds, I put about 20% of my money, rather 15% of my money in debt and bonds. And then I put 80% of my personal portfolio is via the stock market and stocks. And 5% is discretionary cash wherever I feel the opportunity is. But before we can move on to any of these individual instruments, I think we need to address the extremely important concept of compounding.
I wholeheartedly agree with you. Compounding is the magic dust for investing. It helps you make money, it helps you multiply. At its core, compounding makes your money work for you. It makes your money earn money, and I don't think it gets better than that. To understand that better, let's delve a little bit deeper into an example. Let's say I start investing at 18 and I want to invest for pretty much across my career till say I'm 55. Seems about right?
Yeah, 55 is pretty much when people want to, sort of wind down and think about retirement,
Exactly. So we have 38 years of investing, of saving in front of us.
right?
And let's say I save around 50,000 rupees a year. Not a
Okay.
bad amount to start off with.
Yeah, sounds feasible.
Yeah. So 38 years of saving around 50,000 per year. I've saved a total of 19 lakh rupees. Now, not bad, right? So let's say my interest compounds at 15% per annum, which is a little bit more than what our Indian economy has performed over the past few years. But let's take it just for the sake of easier calculations. Now I'm saving for 38 years. When I'm 40 years old, I'm going to have 27 or so lakhs in my bank account. Okay, that's not too much when you see the entire picture, right? 19 lakhs, and I'm having 27 in return. Just you wait. Now at 50, I have 1.2 crores.
That's a massive difference.
Exactly, and that too just within 10 years. And that is the magic of compounding. But we're not done yet. At 55, we're stopping saving. But let's say we let our income compound a little bit more. When I'm 60, I'll have more than 6.5 crores in my account.
So essentially, you're saying it takes time for your investments to actually compound, but when they do, they sort of multiply on themselves so much that they kind of amass a decent corpus.
Exactly. I think investing is a long term game. It always has been. And trying to get out early or, being in a rush is not going to get you the returns you want to.
Fair enough, man. That makes a lot of sense.
That's not the only thing, right? I think compounding also helps you achieve your goals. When I talk about goals, it can be buying a house, it can be saving up for a wedding, it can be almost anything on the planet which I need money for. And investing helps me achieve that. I can set goals on the basis of what I may need in the future. And let's say I require a crore for my down payment on my house. I can invest according to that goal and get to that amount while beating inflation and also amassing wealth in the long term.
You're saying if you have a goal in mind, it's also a big motivator for you to be consistent in your investing.
Definitely, because it acts as you said rightly, a motivation to continue doing that. And I think it's a brilliant cause to continue on.
Sounds about right, man.
So let's talk about that, what it is, and how do we go about investing in it.
So, debt or bonds are essentially fixed income instruments. As the name suggests, you're fixed a certain amount of return that you're going to make, and you know that from day one, from the day you invest in the particular bond. But let's start from the beginning. What is a bond? So, when a company wants to raise money, there's a few ways they can go about it. They can approach a bank, or they can approach an individual investor like you and me, or they could approach the stock market and actually list their company on the stock market. Now, there's a few issues with each of them. If it's just a fairly small project that requires an instant infusion of capital, pretty much, they won't go to banks because banks would like to, they give you an interest rate to pay back, but they can also raise those interest rates for the companies, which is obviously not what they want. Then with the stock market, there are a lot of companies that just want to stay private. Like this, for example, you have Zero, the broking company. They don't really want to go public because they don't need to go public. So instead, what do these companies do? They come to retail investors like you and me. Essentially, what they do is they put out a bond or a debt instrument wherein you're given a prospectus which informs you about where the company wants to invest the money they want to raise from all of us and how they plan to do it and what their minimum amount for investment is and what their expected return is. So let's say a company wants a minimum investment of 50,000. Let's say they're trying to raise 100 crores, and anybody can pretty much invest. And the minimum investment is 50,000 rupees. And they're saying, we'll pay you 12% return. And the period for the bond is 2 years. So essentially, you're going to make 12% in 2 years. And that's, I think, the best part about a bond is that you know what you're getting upfront.
So, as you said, the name suggests that the income is fixed. But are they all as safe, or are there safer types of bonds? And are there riskier bonds?
So there is a catch, so to speak. The higher risk you take, the more reward. Let's say somebody wants a very aggressive portfolio and somebody wants a very risk averse portfolio. There's two types of bonds that can sort of facilitate this. The first type is a government bond. Essentially, a government bond are bonds that are introduced by government entities that pretty much are 99.9% safe. And because they're so safe, they have a fairly low amount of interest rate, which is 6, 7, 8, even 9% sometimes if you're lucky. It all depends on the repo rate set by the RBI. And then you have corporate bonds, which are private companies that sort of want to raise cash, and they could offer you far better returns, maybe 13%, maybe 14%, or even more. But they come with a proportionate amount of risk. So the risk to return sort of funda is extremely important whenever you're considering any sort of investment in bonds, or whatever instrument you're investing in. Rather, essentially, the higher risk, the more reward. The lower risk, the safer it is, but the lower reward. Well, that's enough about bonds and debt. Let's talk about the stock market.
The stock market is a fascinating place. Stocks at their core are part ownerships in a company. Every time you buy a share, you are entitled to profit sharing in the company and usually voting rights in the company's administrative and management affairs.
So, how do you make money with a stock? Essentially, how do you actually build wealth?
So when someone invests in a company, they try to make wealth either through capital appreciation or dividend payouts. A dividend is effectively the share and profits that are given to a person who's holding a share, and capital appreciation refers to the gradual increase in the value of a company.
So you're saying you can either make money by the stock price increasing, or you can make money when the company pays out dividends to its shareholders.
Exactly. I think a question that comes to my mind often is, why do companies even try and go public?
Yeah, why does a company go public? What's the point?
So I think at its core, they're trying to raise capital, and they can raise capital for a multitude of reasons, whether it be paying off debts which they might have, or even to fund their future operations.
That sounds cool, man. Tell me, how do you gauge whether the market is doing good or bad? How do you, when somebody asks you, hey, is the market up or down today? How do you sort of quantify that and give them a legit answer?
I think that's a very important question. I think a few years ago, when someone would come up to me, or people around me talk, and they're like, "Oh, the market didn't do so well today, and the market's doing so great these days." I was always confused, right? I mean, is the market a living person? I mean, how are they referring to this market going up and down? Over time, I understood that when people talk about markets, they're usually referring to something known as a stock market index. An index is effectively a compilation of multiple stocks within a market. It's often representative of a particular sector or even sometimes an entire country or economy. For example, within India, we have two main indexes, the Nifty 50 and the Sensex, which are both representative of the Indian economy. If the economy does well, the Nifty and the Sensex outperform and they do really well, and people make money on capital appreciation. However, on the flip side, when the economy is not doing so well, these indexes tend to decrease.
Okay, so tell me this then. How do you identify a large company and a small company? Like, how do you, besides being part of an index, because let's say the Nifty 50, it only has 50 companies, but I'm sure there's companies that are big and small besides the 50 companies that build make an index, right? So how do you identify and distinguish essentially?
That brings us to an important concept, which is known as market capitalization. It's effectively a simple formula, which is the number of shares that are outstanding of a company, which is multiplied by the company's market price. In simpler words, it's the amount a person would have to pay to acquire the company in the open market. Using this market cap, we can classify companies as large cap, mid cap, or small cap. In India, on a usual basis, small cap companies are ones that have a market cap below rupees 5,000 crores. Mid cap companies have market caps between 5,000 crores and 20,000 crores, while large cap companies have market caps larger than 20,000 crores.
So with this difference in market cap, is there also some sort of risk associated with investing in, I don't know, a small cap or a mid cap versus a large cap? Is there some sort of risk that's, that comes hand in hand?
Oh, definitely. When you're investing in a small cap, you often have a higher risk. These companies are more speculative in nature, they're not as covered in news sources, and there are not as many analysts following them. As such, we're not entirely aware whether their future operations are going to be great or not. But oftentimes, these are the stocks that turn out to be multi baggers. On the other hand, we have large cap companies, which are often lower risk, but they offer a lot of stability and consistent growth.
So do you think the average Joe should have a combination of small, mid, and large cap in their portfolio so as to have a, a balanced amount of risk or whatever, based on their risk appetite?
I think it's a combination of both. An average Joe should definitely have stocks on either side of the spectrum. However, one can choose to overweight certain baskets depending on their risk appetite. But I think that's enough about the stock market. We talked about other investment types as well. So Arman, what about real estate? How does one go about doing real estate investments?
Yeah, so real estate essentially isn't as simple as investing in debt and investing in stocks, because the very principal issue with investing in real estate is that it's very cyclical, right? So you can have long periods of price appreciation, everything's going great, the real estate cycle is doing really well. Then you'll have extended periods of, really bad real estate performance. And sure, you can have cycles in any asset class, but for real estate, they're notoriously longer than usual. That's one issue. Another issue in India is that, well, anywhere rather, is that investing in a piece of land or a house or even commercial property requires a lot of upfront investment. And if you're a 21-year-old straight out of college with your first job, I'm pretty sure you don't have 60, 70, or 80 lakhs to put down for a house that as an investment, because most people finance it with a loan from a bank, and it's just not feasible or advisable to have that massive loan on your back, because it's such a big risk. You don't even know if it's going to do well. So as far as real estate investing is concerned, there's two ways you can make money with it. Obviously, the land value or the real estate value appreciates, or via rent. But in my opinion, it's very unnecessary for the new investor to jump straight into real estate. I think they should stabilize their portfolio with equity and debt first, because those are, you can invest as little as 100 rupees, even systematically, month by month. Whereas you're tying up a lot of your money and a lot of your sort of potential opportunity cost with just one big asset, such as real estate.
Wow. The natural next question is how does one start off? If I want to buy debt or if I want to buy equity, how do I go about it?
So I think, like I said earlier, the most important thing is to define your risk beforehand. If you already know that you want to have a portfolio that's very risk averse, or if it's very sort of aggressive in terms of risk, it's going to be easier for you to outline your investments. So, for example, for myself, I invest 80% in equities, 15% in debt, and only 5% I keep as cash so as to invest wherever the opportunity allows. I like to have a fairly aggressive portfolio because I'm only 21, and with that in mind, I I can invest more in equities. As to how you can exactly go about it, very simple. Let's say you want to invest in debt. There are companies that have made it as easy as just logging into a website and picking a bond and investing as little as 10,000 rupees. One such website is Golden Pi, GOLDENPI. This is not sponsored, by the way, not yet, but um, you can create an account on Golden Pi, and you can literally just pick out bonds, and there's hundreds of bonds out there. Pick whatever suits you and invest as little as 10,000 even. That's how you invest in debt. As far as investing in equities is concerned, you need to first and foremost have a demat account. Again, it takes you maybe half an hour to register for the same. You could approach any big broker, Zerodha, Upstocks, just log onto the website and just fill up the forms. They can ask for your details. So that's how you start off.
Well, we talked about, fixed income assets and we talked about equity, but I feel like it's very technical, right? So for a person who's not interested in finance, for example, I'm a creative professional and I want to make money, but I don't want to analyze financial statements. I don't want to be going through companies and attending conference calls to understand where I should be putting my money. Am I not allowed the liberty of earning and growing my wealth?
Yeah, so I think that's a massive, massive myth in the whole, investing world. Everybody thinks you have to be a finance bro, so to speak, to actually build your wealth, but that's really not the case. I mean, you could be you could be a janitor for all I care, and you can build your wealth. I'll tell you how. So there's two main ways you can invest in the stock market. Let's say there's an active way wherein, like you said, like you rightly said, you analyze companies, you analyze their financial statements, you attend conference calls, and then you individually pick stocks. That is a skill in itself, right? It's a skill that has to be developed. And naturally, you pretty much can only develop a skill to a good extent if you're interested in it. But if you don't care at all about reading these statements or analyzing them, there's a lot of scope for you as well. There's professionals in every industry for a reason. If you break your leg, you go to the doctor. You don't try to fix it yourself. And similarly, if you don't have any interest in finance or in sort of reading or analyzing statements of companies, you have mutual funds. Now, a mutual fund is essentially a fund which is managed by a person who is a fund manager, and he or she sort of collects money from a multitude of investors, and he or she invests that amount in different areas. Now that fund could invest in debt, it could invest in equity, it could invest in gold, or it could invest in a mix of these things and more. um, how do you know where they're going to invest? It's all outlined beforehand in their sort of prospectus on their page. And again, you can directly invest in any of these through your broker. So that's a mutual fund. Another way is through ETFs and index funds. So an ETF is an exchange traded fund. Essentially, what ETFs and index funds do is they track a portion of the market and they mirror its returns.
Can you explain with an example?
Yeah, so let's consider the Nifty 50, right? It's the National Stock Exchange's primary index that sort of tracks the market. It tracks the top 50 companies that it's listed by market cap. Now, it's a little more complex than that, how the actual index is created, but that's not the point. Let's consider an ETF known as Nifty Bees. So what Nifty Bees does is that it you invest in the ETF, right? Nifty Bees. It invests your money equally in all these 50 companies, and based on the growth of the actual index, your money grows the same way. So for instance, let's say the Nifty 50 index appreciates by 14% from this year to the next year. That means your Nifty Bees stocks, ETFs rather, you've invested in, that's going to grow by 14% as well. In the last 40 years, our indices, all of them have sort of averaged about a 14% growth, 13 to 14% growth cumulatively. And if you invest only in index funds, you can grow your wealth by about 13, 14% over a long period of time, just with minimal effort. All you have to do is buy these index funds in a predefined amount every month, or in whenever it dips based on whatever your comfort level is.
Seems like a no-brainer to me. I mean, compared to FDs for giving me a 3% return, I can do absolutely nothing and get a 14% return.
Yeah, exactly. It's pretty much double inflation. But why don't you summarize everything we've talked about, Tejas?
Sure. So, at its core, investing is really important. It helps people grow wealth, preserve their capital, and also enjoy the magic of compounding. We discussed how inflation should be avoided by investing. We discussed how you can make your money work for you instead of you working for your money. We discussed the different types of investments that are available to the investor, whether it be equities, real estate, or debt. And we talked about how you should go about investing in this. I think the most important thing right now is to just start off. Many people get scared by the idea of the financial markets because of the information that they throw at you. However, the first step right now, which you need to do as soon as you finish listening to this podcast, is to go and open a demat account or an account with Golden Pie. Just go ahead and start investing now and make your money work for you. Finance doesn't need to be complicated. We're helping make it uncomplicated for you. We'll be back again next week with another episode of the Fluid Finance Podcast. And remember, we do not make investment recommendations, so please consult a financial advisor before investing your money.